Okay, hi everyone. My name is Tommy, also known as Alice and Bob. I do communications, I do marketing, business development for Mangata Finance. And I titled the presentation today, Solving the Big Problems of DeFi. I like to do big, bold claims and try to pretend that I know everything about the world. But what I've seen today is, what makes me very proud is to work in the Polkadot ecosystem because there are so many great projects and so many great people. And it's really such a great time to be there because, you know, in the past they conquered the world and went everywhere to the world and like people are everywhere on the planet right now. In the future, we might go into space, who knows? But right now, we're exploring crypto and this new space and domain, and it's a really exciting time. And so for builders, it's a great time to build. So let's talk about solving the big problems of DeFi. So for those of you not following the news, we have a few centralized entities that are fighting for dominance. Here are two good friends. I won't be talking about the economic problems that we're seeing and the power problems. What I will be talking about today is more let's say the technical stuff or the stuff that we can actually do something about. And I want to start with this assumption that DeFi is broken. DeFi is broken. And what do I mean by that? Right now, a lot of DeFi originates on Ethereum and similar systems. And Ethereum was not conceived as a system for dealing with money efficiently. It was built as a computer that should run as a computer. And so it has a lot of assumptions that do not really work too well with DeFi. So let's call it the first generation of DeFi and look at a few of the problems that we at Mangata are looking at especially. So the first and most tangible problem is that you have high gas costs. So traditionally when you're investing money, what you are getting as one of the very first ideas is $2 cost averaging or whatever, euro cost averaging. So invest maybe, if you can, 100 euros, $100 per month into stocks or crypto or whatever. Now, if you buy on Ethereum for $100 per month crypto, you are always paying gas costs. If you have a low time right now, maybe a few dollars. In the last bull market, it was like $100, and if you chained 3 transactions together, it was $300. So high gas costs is like a very substantial problem, and Ethereum is not conceived to offer you cheap costs in this regard. It's conceived in a way to manage the resources it has. DeFi tokens have a low correlation with protocol activity. For example, Uniswap, it's a very successful protocol for swapping, but the Uni token is just there for like off-chain governance, so it's not really connected to the protocol in any way. If you have ETH, you have to make the decision if you're staking it to secure the network or if you're using it in DeFi. So you have to make the substantial decision, and ETH cannot be used as a very capital efficient tool to you have to make a decision. So it's like splitting the attention of what the token can do. So this is the category of the economic inefficiencies that we're seeing and looking at. And then there are also misaligned incentives. And if you look at Bitcoin, one of the very subtle but ingenious things that Bitcoin was doing was that it was aligning the incentives of the node operators, the miners, and the people using the network by aligning the incentives in giving miners rewards in the stake, in the tokens of the network. And a lot of the stuff we are seeing today with all of the stuff that you are building is that we are looking at how can we align incentives. How can we align the incentives of attesters and users and verifiers and so on. So one of the biggest problems and one of the most corrupting problems in Ethereum that we see today is the problem of MEV. A few people are aware of it, but not everyone is aware of it, and it's actually a very substantial problem. And the problem is, let's say you're doing a swap on an exchange in Ethereum today, and you're trading a little bit of a larger amount. So what you always have to assume is that the price can change from block to block. So when you see a price on the user interface, the price might have changed in the next block. And so that you're not always getting blocked, like that your transaction doesn't fail, what you need to do is allow for a little bit of price change from block to block. You say, slippage is okay to me if the price slips like by 1.5%, it's okay for me. So now a bot will see when you submit your transaction and it sees that you're okay with the thing being more expensive by 0.5%. So if the bot has a little bit of capital, it can come in right before you because he might put the transaction before your transaction in the block, push up the price a little, buy a little bit of the thing, then your transaction comes in, pushes the price up even further, and then the bot sells the stuff that it just bought. Yeah? It's called front running. So the bot front runs your transaction, then your transaction, and then he back runs your transaction. And basically takes your slippage, steals your slippage. Front running is becoming a huge problem, and MEV is becoming a huge problem in Ethereum, because this happens before anything is committed to the chain. So when you're submitting the transaction, it goes into this mempool. This is like a storage of all the transactions that could go onto the chain. Now, there are a lot of nodes colluding, like miners, validators are colluding and looking at the transactions. And basically, when a node gets the right to create the block, it sells off the right to decide how the block is composed to other parties. This is MEV, and it's becoming a big industry. Last year, there was $1 billion of value extracted from traders and from people who wanted to just interact with the chain. And it's becoming a whole industry, and it's corrupting Ethereum. The funniest and worst thing of all is, so the biggest entity that is doing this is called Flashbots. You might have heard of them. And Flashbots are offering also OFAC compliant nodes. So so like blacklists of people like Tornado Cash and so that are censored. So any OFAC compliant list is getting, any transaction coming from there is getting censored. So not only are they stealing from people, but they're also contributing to the censorship on Ethereum. So MEV is a huge business, and it's spreading to all the other ecosystems. So all the other ecosystems get infected with this idea. And the dominant narrative is that you can't do anything about MEV. It's happening because there are economic incentives to steal from people. So if we can't do anything about it, we are going to play with it. So this whole narrative, and it's very dominant in Ethereum, is about MEV democratization, which basically says, if everyone is doing it, it won't be so bad. We are basically mitigating the effects. Protocols are playing into this by basically saying, if people are extracting the value, then we should extract the value. So protocols are starting to produce outlets for MEV extractors to basically share the revenue a little bit. So if you're stealing, I'm making it easier for you, but you're also giving me a little bit of that. And it's insane. And the problem is a lot of people are accepting this narrative. The founders of Mangata were saying that it doesn't have to be that way. And so we are following the idea of MEV minimization. We would like to prevent it as good as possible, but it's like a super complex game. And so the approach we're doing is looking at how MEV is working and then trying to minimize the effects as good as possible. And we have found some good solutions to this. Okay, like this is a big problem, that's why I spent some time here. Next problem, mercenary capital. And you usually see this when there is a new exchange starting or something. There is like people that have a lot of liquidity come in, they farm all the incentives, like liquidity mining rewards, and as soon as the profitability goes away, they leave. And so you have this capital that is always moving around, trying to extract the value where it can do it the best. It's having this name of mercenary capital. I mean, it's just opportunistic and it makes sense to do it, but it creates instability for the user because the user cannot rely on having a certain degree of liquidity and basically have stable prices. As a user, you always have to feel an uncertainty if you're going to the exchange, if it will be a reliable service and experience for you. So, and I think this is a very important problem because like everyone who tries to participate in liquidity mining usually if you talk with retail users, so regular people, they're getting wrecked. They're losing money in providing liquidity. And I think the biggest issue for this is that people are, understanding liquidity is super hard and takes a lot of time. I've been spending a year of my life now thinking about liquidity, and there have been many days where it was the first thing I was thinking about when waking up and the last thing when going to bed, like understanding all the mechanisms. I have a feeling I begin to slowly understand it, but it's like you can spend so much time on understanding it, and it's something where people just get wrecked on. So the founders of Mangata like to talk a lot about MEV, but what I realized as a marketing guys, they just like to think about a lot of problems. Like, they like to think about and identify problems that are existing there and then finding solutions to them. So this is why the presentation is called like this, because we were just looking at all these problems and are developing solutions for this. So let's fix DeFi. My body's always shaking when I'm giving a presentation. Okay, so the end game. The end game of DeFi is capital efficiency. What does it mean? Yeah, so what is capital efficiency? It's a super important concept. It's one of the most important concepts in DeFi, and that is how much money do you pay to get something? And capital efficiency means you pay less to get more, or if you pay the same, like, yeah, you want to have like the lowest price to get something. Let's say you could buy some DOT today on one exchange where it costs, let's make an extreme example, on one exchange it costs $5 and on another exchange it costs $7. Yeah? You have the best capital efficiency if you pay the least and get the most. Now let's go back to the Ethereum example of high gas costs. If you want to do dollar cost averaging and you're paying like $5, $20, $100 for every transaction, it's not very capital efficient, because on top of the gas fee, you also have to pay an exchange commission. So there is a lot of competition in DeFi protocols on looking how can we be more capital efficient. We were having this presentation today from AskRedDAO, and basically the claim was no interest rate and like very low fees. Yeah? It's very capital efficient, it's very attractive to you. So there's a lot of competition in DeFi protocols and finding ways to be more capital efficient. And we also have something to offer here. But because Ethereum and a lot of other ecosystems are capital inefficient in the way that they are producing gas costs or other things, you have to assume that in the end, in 5 years or so, 99% of the DEXs you see today will be dead, they will be gone, because there will be more capital efficient DEXs. And if all else is equal, you will go to the exchange where you pay the least or get the most. So that's why I'm saying the end game is capital efficiency. This is like one of the most crucial aspects. But the problem with capital efficiency is that it is centralizing. So one of the most capital efficient exchanges in the world is Uniswap version 3. Because, I could go into the details, let's not go there, but it is very capital efficient, and so it's centralizing in the way that a lot of liquidity goes there and a lot of traders go there. MEV is also centralizing because it's like creating capital efficiency for the people stealing the money. And so capital efficiency is super important, but it's creating centralization. That's why we call it Wall Street, because all the capital was centralizing to this place. So you have to counteract this. And the way to counteract this is if you add additional values. And you not only have a value of capital efficiency, but you also think about fairness. So fairness is hard to define, but let's make it simple and let's say fairness is at least creating a level playing field where all the liquidity providers are getting the same chances and where also traders get the same chances. So this is a little bit ambiguous, and so it's very much subject to interpretation. And this makes it less easy, because if you want to be the most capital efficient exchange, you look to implement the Uniswap version 3 model, you go look and implement the curve-like model. But maybe you have other values like fairness. So I think this is a summary slide. No, this is like a slide. Oh. Yeah, we talked about this. Let's move forward. So, parachains to the rescue. This is the thing that Polkadot is doing really well and is doing really great, is that it can optimize for certain use cases. And you can change the rules of the game of how everything is working. So you can build your chain that has different rules that can be optimized for capital efficiency, that can be optimized for fairness, or whatever you think is a good thing. So it's our chains, it's our rules. This creates a lot of opportunity, this creates a lot of innovation, it will create a lot of problems, and it will create a lot of drama in the future. I'm hoping to see that point in time, but it's also creating a lot of opportunity and optionality in this space, and it makes the whole system more expressive and powerful. So it provides us with the ability to fix bigger problems. So this is what Mangata sets out to do. And so this is how we are positioning ourselves now. Mangata is the DEX of Polkadot. We know that there are a lot of other good exchanges, but it should express one idea. It should express the idea that we're focusing on one thing and trying to do this exceptionally well. And this is also a thing that you see in Polkadot, is that you have very specialized parachains. And some people are questioning, is it really a good idea to make like such a specialized service? Do you need decentralized identity? Do you need like a chain just for zero knowledge proofs? But the thing is, the teams can focus and specialize on just that thing and do it really well. And so we are focusing on providing an exchange that really makes the exchange experience awesome and great. And the great thing is that Polkadot allows us to interact with each other. So a few design goals we set up for Mangata. It should minimize MEV. It should optimize for capital efficiency. We want to maintain an equitable and level playing field. And of course, it should have an economically viable business model for the chain. Yeah. I'm finishing just in time. So I could talk an hour about this, 20 minutes about this, half an hour about this, and maybe half an hour about this, but I won't because they don't give me the time here for this. But the interesting thing is, so this is basically the layering of a blockchain that you're getting. On the trust layer, what we are adding is that we're not doing a proof of stake system, but we're doing a proof of liquidity system. So what it does is, you're not staking native tokens to produce trust, but what you're doing is you can stake liquidity. And what it does is it unlocks the capital efficiency of the native token, which is on Mangata X, on Kusama it is MJX. On Mangata it will, so on Polkadot it will be called Mangata, it's MJA. And it unlocks the capital efficiency because the token is not staked and unusable, but it is acting in liquidity. So our native token paired against another token in liquidity is creating the trust, and you have to add more trust assumptions here and basically make the system strict in a way that you can still maintain the security. But it unlocks the capital to be also working on the execution layer in the exchange to provide as deep liquidity as possible. Good. On the consensus layer, we are adding a new thing. So usually consensus means there is no double spend or people like spending tokens on different things, or like consensus means the rules that the chain implies that you have to follow. And the trust layer secures that consensus will be held. So what we're adding here is Themis architecture, which is a new protection against economic, so it's adding economic security in the way that we built a mechanism to prevent front running and MEV. I don't have the time to talk about it, but you can find a full blog post and a video on our blog. If you're interested in how we change block production to be more complex and more fun, you can look at Themis architecture. And since my time is running out, we're doing gasless swaps, and it's not like just a funny claim, but we looked at the cases, we modeled the cases, and we can provide gasless swaps in most of the cases. Algorithmic bind burn connects the economic activity of the chain with the value proposition of the token. So with each swap, a little bit of the native token gets burned, bought and burned. And time incentivization is a mechanism that basically increases your liquidity mining rewards over time the longer you provide liquidity. So it should create calmer liquidity. The liquidity doesn't move as hectic. And all of these things are designed to work together in a way that creates deeper liquidity, more capital efficiency, and still maintains the fairness for the users. So last slide, summary. Where are we going at? We want to fix DeFi with all of you together. Mangata is the DEX of Polkadot. Will be in the future. We want to give exposure to Web3 projects because usually they're not so experienced in DeFi and what you can do and like how you think about liquidity and all those stuff. They want to build a cool Web3 project. So we want to give them access and like make them economically accessible to the ecosystem. And we want to bridge to all major ecosystems so that we can list all the tokens. Today, Imbio launched. And if you want to list your token on Mangata, you can get in contact with me. You find me on Twitter, Edison Bob. And that's it. Thank you.
1, 2. Do you hear me? 1, 2. Okay, yeah, that's better. So yeah, next time we're gonna make an event only for Tommy to take us like to deep dive into DeFi. I'm pretty sure we could all learn a lot. There's one thing for sure. Next time that I'm going to be messing with DeFi, I'm going to give Tommy a call first because there is, so many little things that I'm pretty sure most of us don't even know about it. So, do you have any questions from the public? Okay.
Give him the mic.
1, 2.
Thanks.
Yeah, I have a question about providing liquidity. You've mentioned really nice reason for trading, that it's cheap, zero cost for transaction, and because of burning. The burning is it's meaning that the trader is losing the amount what is burned, or the providers of liquidity lose the amount what is burned. And why is, let's say, profitable to be there for liquidity providers?
Yeah. So you're talking about the buy and burn, right?
About liquidity providers.
Yeah. Okay. So most exchanges have the model that every trade costs 0.3% exchange commission. And then is the question what do you do with the exchange commission usually? So some models give all that value to the liquidity providers. We are splitting it up into 3 components. So 0.2% go to the liquidity providers. That's basically what they're earning on providing liquidity. 0.05% go to the treasury. So the protocol is earning revenue and can do something with the money. So 0.05%, what is this? If there is $1 million in volume, $500 go to the treasury, $2,000 go to the liquidity providers, and 0.05%, $500 go into buy and burn. So it means there will be MGX bought on the market and burned immediately. And it is an additional incentive for MGX holders, and it also opens up the system because we have a hard cap of tokens. And so at some point, you would be running out of incentives to give away. But if there is, the volume is continually burning tokens, you have also like an infinite source of incentives to give out. Yeah? So by combining these mechanisms, it's like a really elegant system that can combine a lot of design goals. Yeah, I hope this answered it.
Yeah.
Okay.